Hey everyone, what's up? Hi and welcome to another lecture by SR Trades. Today's topic is gonna be what is the stock market? Now let's get started. With a disclaimer that this video is only for education purposes, not for any kind of stock tips or trading tips, buy sell recommendations or anything. So let's just get started with today's topic. Now this is a little intro about myself. Hi, I'm Shumali. I worked as a senior equity research analyst at a firm for 2 years. My main work used to consist of reading through financial data, understanding them, making reports, and delivering it to clients. Now, in that entire experience, I've always understood one thing, that people are pretty much interested, or they know the term stock market, but they have no clue about the things in detail. They just know the tip of the iceberg. Now, today I'm here to break that entire thing down in very, very simple terms. Let's just get started with the first thing. I'm pretty sure you guys must have heard about these names from your day-to-day life. Zomato, Swiggy, um, here I've mentioned Jio or HDFC Bank, any big company, TCS, Reliance, whatever the big companies are, you've probably heard of them. Now the thing is, do you know what the companies actually are, and that you can be a part owner of the company and make sure that your wealth grows as the company grows? So, for example, this is what is today's agenda to understand what is the stock market, how do you make money in the stock market, and how do big companies make money from these particular things. Let's just get started. Here's the first thing. First, you have to understand what is a company and why does it need money. Now, I've taken a very small example. I've used an example of a tea shop. Now, let's say you have started a tea shop and you want or you need more money to make sure that you're expanding your business to different cities, just to make sure that you're making more money out of it. How to do that? You have two options. First option is definitely you go to a bank, you ask for a business loan. Now, in that scenario, no matter how your company is performing, whether you are making money or not making money, you are liable to pay the bank the money you have taken from bank, followed by the interest, no matter how the business performs. On the other hand, there is another option, which is find people who believe in your business and you give them just a part of your company. In return, they're gonna give you with their money, so that you can use that money to expand to different markets or expand your business to different market or different locations. Now this is how it works. Give them a small ownership stake. They give you the money. If the business grows, they benefit too. If it doesn't, they take the risk with you. Or in simple words, in option 2, if the company works very good, the people who have shown trust in your business, their money also grows. On the other hand, if it fails, you're not if it fails, they are also willing to take that kind of loss with you, because they are the one who were owning a little bit part of the company. Now the same thing happens with big companies and all. You can buy a part of it. You can just own a small part of the entire company. Let's say a company is worth 100 rupees. You can just invest 1 rupee into that company and you can just own 1% of the company. This is exactly how it grows. Now I've just shown this with a picture so that it's easy for you to understand. This is how the stock ownership thing happens, and when the company grows, your share value grows in value. How? When the company makes money, it expands, it makes more money. The more money the company makes, the more value of your share goes in the future, so that after a period of time you can generate wealth out of it. So I'm gonna break that down in simple terms first. What is a share? Okay. Now use this example over here. Imagine a company is worth 100 crore and the founders decided to divide the company in 1 crore equal pieces. Now if each piece is worth around 10 rupees, that means 1 crore shares will worth 10 crore. Now think of it. Company is worth 100 crore. 90% is with the founder or the people of the company. 10% they are willing to give it to other people so that they can raise money against the 10% stake of the company. Okay, now the 10% of the company, they are going public for that. Okay, people can buy parts of it. So in this particular picture I've shown that if one share costs around 10 rupees, that means you own 1 by 1 crore part of the company, because 1 crore shares were there in the market. Okay, this is your ownership or your share. Now for one share you have invested around 10 rupees. Over a period of time, as the company's value grows from 100 to 200 crore, because of more money coming in, the company expanding, the company making more money, you are still owning just 1 by 1 crore part of the company. But what is happening, your 10 rupees goes up to 220 rupees. It doubles in value as the company's overall value doubles over a period of time. So this sounds tiny, but think of it with a 1 crore, 2 crore, 5 crore kind of a money. I just told you about 10 rupees. That is basic idea of what is a share and how it performs or how it works. Now, how does a company list in the market? This is all complex stuff and all. I'm gonna make it very easy for you all. Let's just use a marker for this thing. There's a company X which is private company. Private company means this is not listed in any kind of market. Normal people cannot directly invest into this company, cannot buy the shares of this company. Now to make sure the company, let's say the company wants to wants more funds to expand their business. How do they do that? They go to the market, they list their company in public, and this process is basically what we say as IPO or initial public offering. What it means, a private goes from private to public through an IPO. The IPO makes that happen. The entire process or the entire thing is basically known as IPO, initial public offering, the process through which a private company opens up ownership to public and lists on the stock exchange. Now, who are the people, or what? How does it work? There are investment banks who actually help the company to decide how many shares it wants to issue and at what price and all. And SEBI is the regulator who sees everything over here. Now, once the company is actually out there in the public, you can use your Demat account to buy shares in that company. We'll come to that part later. Now, what if the IPO is oversubscribed? What do you mean by oversubscribed? In simple terms, there are 100 shares available for the company in public, and there are 1,000 people applying for it. That is the meaning of oversubscribed. Undersubscribed means 100 shares are available and only 50 people are applying for the shares. That is called as undersubscribed. Now, you must have heard about these companies lately. These are a few companies who have actually went public in the last few years: Zomato, LIC, PTM, Bazaar, etc. etc. So, what is this IPO? It's basically how a company, or the process of how a company goes from private to public. Now, this is interesting, the idea of stock exchanges, NSE and BSE. Now, where is this buying and selling thing happening? Before this, I'm going to make this very easy to understand. This is your grocery market. This is Bombay Stock Exchange or BSE. This is National Stock Exchange or NSE. This is a supermarket where you go to buy your items. Okay, so if you go to a grocery market, you'll probably get your groceries and your daily needs and all. But in BSE and NSE, what happens? This is again a market, but instead of your groceries, you get stocks. So in very simple terms, the grocery market or the supermarket where you get your groceries and all, you go and buy groceries in these exchanges such as BSE or NSE. These are also supermarkets, but for stocks. You can go there and directly buy stocks from these places. Now, you have probably heard the term Nifty and Sensex. What are these things? Imagine you're taking a basket over here, and this basket has the top 30 items of this entire supermarket. That is nothing but Sensex 30. Sensex 30. What is this thing? It holds a part of the top 30 companies in this market. Similarly, in Nifty, you have another, this is also called the index by the way. You have a basket called as Nifty. This has top shares of top 50 companies in one basket. Okay, just a part of those companies and all. So that's why we have the term Nifty 50 and Sensex 30. Everything is given over here. This again as easy to understand that BSE was established in 1875, NSE was in 1992. These are a few basic things. Now most stocks are listed on both NSE and BSE. As a trader or investor, you don't really need to choose. You can choose from your broker, but it's not that compulsory. Yeah, this is important. NSE somehow is more liquid. The trading volumes are higher. In BSE, the trading volumes are a bit lower. This is like a thermometer for Indian economy. When the top 50 companies are going very well, we say that Nifty goes up, and when they are struggling, we say Nifty is coming down. That's the basic idea of when you hear the term, okay, Nifty is up today 2% or Sensex is down today 5%, not 0.5% or something. This is exactly what it means. These are just measuring sticks. They tell you how the overall market is performing on a day-to-day basis. Now, who are the players involved in the market? Now, there are 4 major players in the market. First is people like us, or the retail people with small or limited amount of money. Then we have the foreign institutional investors. These are foreign companies who are willing to invest in India and take major stakes in our economy. For example, these funds can be something around on a daily basis. I'm saying they can buy and sell 1,000, 2,000, 3,000, 4,000 crores on a daily basis. Similarly, we have Indian companies as well, which is known as the DII or the domestic institutional investors. From the name only you can understand. These are what? The mutual funds, pension funds, retirement funds, insurance companies. These are the companies who act as DIIs and they invest their money in the market. Again, we are dealing with 1,000 crore, 2,000 crore, 3,000 crore, something like that. And then comes the promoters or the major shareholders or stakeholders of a company. Who are these people? These are the founders and major shareholders. Like the promoter is basically known as this thing only. How much of the company they own and whether they are buying more or selling more their stake. This tells us a lot about the health of the business. So in very basic terms, if you see, promoter is, let's say today is a company C, and I'm the founder of it or the promoter of it. Today I am owning 5% of the company. Okay. In the next 3-4 quarters, I've increased my stake from 5% to 20%. Now that is a very good sign. That simply means if I'm increasing my holdings, being a promoter, that means I am forecasting that the company is doing well, and maybe in the upcoming future the shares of the company, the value of the shares of the company, they're gonna go up. That's the reason why we usually say that promoters, if the promoters are increasing their stake in the company, that is a very healthy sign. On the other hand, if they are selling stakes in the company, that can be because of 2 reasons. One is they can understand that the company might go bankrupt or the company might perform in the upcoming days. That is one reason to sell. Or the second reason to sell is they need more money. They sell some portion of the company so that they can take in more money to expand the business. So there are 2 reasons for that. And as I've mentioned, promoters buying more, that's a very, very positive thing. Now usually because of the interaction of retailers, then FIIs, DIIs and the promoters and everyone, this is the reason why we usually see charts in the market and they move up and down. Okay. Now how does the stock price move? I've used a very, very simple logic of supply and demand over here. You can just read this thing, but I don't really want to complex this thing with all the difficult jargons and all. I'm gonna make it very easy. Let's say there's a shopkeeper. Okay, he has 10 items in his store. 10 items. So in this scenario, the supply is only 10 items, limited edition, something like that, and there are 50 people in the market who are interested to buy this. This is pretty easy to understand, right? There are only 10 items in the market, 50 people are willing to buy it. How will the shopkeeper sell it? The person who pays more. So demand over here is 50, supply is lesser than demand. Yeah, supply is lesser than demand, it's 10, it's 50. Hence, price of these items can move up higher. Like if one item costs around 100 rupees, the shopkeeper can charge even 10,000 rupees for that one item because more people are interested to buy. There's always a buyer who is willing to give a better price. On the other hand, just reverse the conditions now. Let's say there are 50 items in the with the shopkeeper and only 10 people want to buy it. Then the supply is 50, demand is 10, supply is more than demand, price goes down lower because the shopkeepers will be in a hurry to sell those items so that he can bring in more items of another thing which are gonna sell fast or which has a higher demand, because this is probably a loss making item for him because people are not willing to buy those items. And what if supply is equal to demand, 50-50? Usually price stays same. Okay, that's the basic idea of supply, demand and price, nothing else. Now we come to what is SEBI and why it matters. So SEBI's job is to protect investors' fund from any kind of fraud or manipulation in the market, also to regulate the exchange brokers and listed companies, ensure companies disclose everything accurate, then prosecute the insider trading and market manipulation, and as usual, register and regulate market intermediaries, brokers, advisors, research analysts, and all. Now, to break this thing down in a very simple term, SEBI is like the referee of the stock market. As simple as that. Make sure everything is correct. This is the most easiest version of saying what is SEBI. Now, how do you really participate as a retail trader or investor? This is the basic thing. For if you want to, okay, let's just go with again an example. In a bank, you have an account where you can store cash. Similarly, to hold stocks, you need an account. That account is known as Demat account. This is what I've mentioned over here. Demat account is where you can actually store your shares digitally. This is like a bank account but for stocks. There are many brokers in India: Zerodha, Upstocks, Dhan, Angel One, Kotak, and then Axis, HDFC. A lot of things are there. You can select any one of them. I personally use Zerodha because somehow the UI is very easy for me to understand, but it depends from person to person. Now, how do you actually buy stocks over there? You open an account, you add funds from your bank account to Demat account, and you start buying using the Demat account. It is literally that easy. So you open the Demat account, add funds, start buying, become a part owner, build wealth over time. That is exactly how it works. So today, in a nutshell, we have just covered everything about stock market in very basic terms. I have not really used very difficult jargons to understand, broken down into very simple, easy explanation so that you can understand what is the stock market. Now, for me here, my main goal is to help people become aware of these kind of things and take decisions financially so that in near future they can generate a lot of wealth and they can act today so that people can start acting today and make good amount of money in the future. Now, I think that's it for today. We'll just wrap it up. I'll also drop the link of my previous video where you can understand why do we need to invest and all. Do watch that, and this. Please make sure you like, comment and subscribe if you like the video. Okay, that's it. We're gonna meet again next week with a different topic. probably something more interesting. Let's see. Okay, thank you for watching. Bye bye. Take care.